Hey everybody, welcome back to Dividend Stockpile. Today I'm joined by Clark Allen, Head of ETFs at Horizon Investments. We're going to take a closer look at two of Horizon's new ETFs, DIVN, the Horizon Dividend Income ETF, and FLXN, the Horizon Flexible Income ETF, and explore how they fit in today's evolving income investing landscape. These ETFs combine underlying income generating holdings plus an added option strategy to enhance income to investors. So Clark, welcome to the channel.
Thanks for having me, Jeremy. Happy to be here.
So I guess at a high level, can you explain who Horizon Investments are and what's your role at the company?
Yeah, so Horizon, we kind of describe ourselves as a firm that sits at the intersection of wealth management, investment management, and technology. Why is that? Is because we're not just a traditional asset manager. We partner with advisors and help them support their businesses. Goals-based frameworks is kind of what all of our investments are built around, but I say wealth planning because we came out of a wealth planner, and technology is core to just how we describe strategies. Because as you probably know, Jeremy, talking to a lot of folks, there's a lot of really cool, innovative solutions, but helping investors understand how to use that and pair it alongside other strategies is really the key. Because an individual strategy is not necessarily a good idea for you to just own one. You need to own several, and then how do you pair those together? A little bit about my background. I've been at Horizon 7 years, spent some time at a multi-billion-dollar single-family office, spent some time in, I call it institutional asset management at an insurance company in the asset management arm. As you know a little bit about that per se. And then, so sitting here today, I'm at Horizon 7 years. My most recent role is I'm head of ETFs. And so this year we had a pretty aggressive plan to launch 12 ETFs in the calendar year 2025. We've already done 9 so far. We just crossed $1 billion, which is a phenomenal start to, I'd say, our active ETF history. I can go into sort of our history in ETFs, but we have 3 more slotted for the end of this year. So hopefully we hit the 12 we want this year. And then we have a nice start to 26, hopefully raise more assets and go from 1 billion to 2 and 2 to 3 and on. So it's been a great run here, and been an exciting time being ahead of ETFs in this current environment with the amount of ETFs that are coming into the marketplace.
I mean, you guys have so many ETFs already. You have lots of mutual funds. You guys have been in the business for a very long time, and your assets under management is quite impressive. But you're just rolling out these new ETFs, which definitely piqued my interest. So I wanted to review those with you. But thank you for that background. That's awesome.
Yeah. Well, I mean, what one thing that's really interesting about us, Jeremy, is we've spent a long time being what they call a model provider, an asset allocator, using what used to just be passive ETFs. I'd say since 2019, ETF rule, options-based strategies, as you know, right, with your podcast, there's been a lot more innovation in the ETF ecosystem. And so as an allocator, it gave us a lot of choice, but then it was like, wait a minute, we only have mutual funds. There's a lot of cool innovation happening now in the ETF wrapper. How do we get to be a part of that and not just use these passive products anymore? And again, these two we're going to talk about today are pretty interesting, but I think there's so much innovation happening across the marketplace. I could talk for hours about all the cool things happening within ETFs and all the innovation that's happening. So
yeah, so I guess with that, let's stick on that topic for a few seconds at least. So there are so many innovations and there are so many new things coming out. What kind of trends are you seeing in the ETF environment, and what are you guys looking at to possibly roll out in the future?
Yeah, for us, it's all about, again, because we're a goals-based asset manager, and for us, it's all centered around financial planning and advisors. It's how do you drive outcomes? And so in the case that we're going to talk about today, that's going to be income. We think that active strategies are, one, really good at providing potential alpha. But we also think options paired alongside active strategies give you the opportunity to engineer a solution, which then drives towards an outcome. So today we're going to talk about how you can drive towards an income outcome. You can use options, I say, to add risk, take away risk, or add income, right? And if you just think about those 3 things, then how do you design strategies that either add risk, take away risk, or add income? And then how do those pair alongside other strategies?
Absolutely. And to your point, there are so many new ETFs coming out there and so many new strategies. That's why I love having you guys on the channel to really explain what the details are. I mean, I could do a video just saying, hey, this is DIVN and so on and so on, but getting you guys from the company to explain the objective and explain the strategy and the rationale behind it and what you guys are looking at goes a long way. So it helps the retail investor really know what's out there and how to differentiate one product over the other. So I really appreciate you guys coming on and talking about these. So let's dig into them. So DIVN and FLXN, that's the Horizon Dividend Income ETF and the Horizon Flexible Income ETF. So on a high level, can you explain what each of these do?
Yep, DIVN and FLXN. That's what we call them over here. So these are 2 strategies we designed. We've launched 9 this year, so it was all around different core building blocks. DIVN is a dividend-focused strategy. So we've been running it for a long time, a mutual fund, which we had talked about, that is sort of like low tracking error basket to the S&P with an option overlay. And what we found is, although that strategy is great, we'll eventually hopefully get it into an ETF wrapper. We needed something that was very dividend forward. We think value, more importantly, from the value factor that typically comes through the dividend lens. Now, that does lend itself to potentially a defensive exposure. And so also, as you probably know, Jeremy, right now, dividend yields in the S&P is about as piss poor as it could be. I mean, it's about 1.5% for the S&P, which is just atrocious. And we also know that, let's just say you want to go buy dividend stocks. They can be quite risky in terms of a tracking error and can tend to be quite defensive. And so just trying to reach for 4 or 5% yield through stock selection is not going to give you a good experience all the time. As you probably know, you might just have to own just energy stocks, frankly. And so we said, how do we give somebody a dividend tilt, right? High quality dividend payers that we really believe in. But you do that, you're probably going to have about a 3%, 3.5% maybe dividend yield. There's no way to get it any higher. So how do you give an investor something that they're looking for, which is like the 4 or 5, maybe reaching 6% yield, but not have to do that by just adding tracking error and risk? And so what we did is we paired a stock selection basket with an option overlay to give that sort of distribution yield that a client's looking for, but in a thoughtful manner, right? It's all about design. And we can tell them with confidence that this is going to be a high quality dividend basket, but we also can tell them with confidence that you're going to get about 4 to 6%, depending on what we can get from the option income over time. And that's going to happen with consistency. And with the FLXN, which, sort of pivoting, this is a fixed income strategy. So we launched 6 equity strategies, 3 fixed income. This is the high yield version. And so this is an underlying high yield exposure. But what we found is, in the case of the way we've sort of put together solutions, folks want a little bit of extra juice on the high yield side. And so we've used options to add a little bit extra. So we'll just say this is about, we'll call it a 1.2 to 1.4 of high yield. So, if high yield bonds are at a 7%, you could probably end up at like a 8 to 10 on average. Obviously, the option overlay could go both directions, but the hope here is to give them sort of like a high yield plus type exposure, which then they can use knowing that they've got a core fixed income or a defensive fixed income. They can pair that alongside. I wouldn't recommend somebody owns it individually, but it fits, right? I mean, if we think about portfolio allocation, it fits in the context of portfolio allocation the way we think about the world.
Yeah, I love the combination of having a strong defensive underlying, but also doing the option strategies on top of it to gain that little bit of extra income. Because to your point, you're not going to get any yield on the S&P 500, and traditional dividend stocks are in the 2 and 3% for the quality ones. So if you're needing or wanting a higher yield, throwing in an option strategy on top of that definitely makes it much more appealing to income investors like myself and like most of the people on the channel. So going back to DIVN or Dividend, looks like the top 10 are like super quality high quality names. So we have Johnson & Johnson, ExxonMobil, Procter & Gamble, Merck, Qualcomm, McDonald's, like all the ones that any kind of dividend investor would love to have in their account. And obviously those are the top 10, but you guys have quite a significant list of holdings on the dividend side. But then you're doing an options overlay on the S&P 500. So you can talk about that part a little bit for me?
Yeah, so I think right now we've got like 130 names. I'd say a dividend tilted portfolio, high quality. So that's important to us. And I'd say the beta of that underlying basket is pretty common with what you'd find from a core dividend strategy. So like the 0.75 to 0.85 relative to the S&P. Now, obviously, where you need to get careful then is if you're going to put an option overlay on that, you could get a beta down to 0.5 pretty fast if you're not careful.
Yep.
And so we were very careful with the construction. And again, we've been running this for a long time in other vehicles. And so what we're doing here is we're doing a call on the S&P. Obviously, there's some potential basis risk here, but we understand that, and that's where you kind of come into the sizing. We're doing a 20 delta call, right? You need to fix a few things, right? So there's if everything is moving, then you don't really know what you're getting. And so what we've said is we want to target 20 delta call, and we roughly want to target a 22% coverage of the portfolio. So we're only going to cover 22% of the portfolio notional size. Now, what's different about that is if we're in an environment where vol spikes, we're never going to reach for anything more than an 8% annualized yield. Because in an environment where let's just say the beginning of this year or 2020, where vol spikes, the last thing you want to do is keep yourself capped, because a ripper is the thing that's going to destroy your portfolio and drive your beta down. And so we'll say if we're getting because vol has spiked more than an 8% annualized yield, we're going to bring the notional cap from 22 down to whatever we need to make sure we don't ever get more than an 8% annualized.
Okay. Yeah,
And that helps size it. Also helps give you market capture, which we think is critical.
Yep.
And where we end up sort of landing, if you were to go look at all the history, is you're probably going to get about a 2 to 3% additional yield or distribution yield from that. You put that on top of, right now we're sitting at, we'll call it 3.5% for the portfolio. Obviously, if you go back to a historical period where S&P is not 1.5, the all-in yield is still attractive. And I think that's the key for us is we didn't want to reach, because when you put this in a portfolio, if it's a core holding for a retirement investor, giving them a 0.5 market capture is just not palatable from the way we think about portfolio construction. And so it's all about sizing the different components of risk to make sure you're still giving income, but you're not giving up too much of the risk capture.
Yeah, I totally agree. It's all about total return at the end of the day. And if you're only writing on 22% of the portfolio, you're leaving the remaining 78% to have capital appreciation or the upside potential, and as well as getting the dividends from those holdings as well. And a 20 delta is a very conservative delta when it comes to the calls. When I do my own call writing, I keep it at 20 or less. So a very conservative approach. It still gives you that little bit of extra juice, as you said, a little bit of that extra income from the options that you wouldn't get if you were just a dividend investor itself. So it was a pretty good package in my mind.
Yep.
Now, this one just started a couple months ago. I think it was in July or end of June, sorry. And it's already accumulated about $125 million in assets. So that's a pretty good raise so far.
Yeah, it's because, again, we've thought about it as a core holding, especially for a retirement investor. And so in the context of somebody that's, again, model portfolio, you're an advisor, you have retirement assets. If this can be a core holding, how do you design it in such a way that it can be that core, right?
Yeah.
A component piece that's pretty critical. You can't reach for yield or you're going to give up too much, right? Because it's all about total return. And so that's how we've gained assets, is because we designed it around a need that we saw in the marketplace. Because there's stuff that can give you more yield. And there's stuff that can give you dividend exposure. And some of that may not be dividends you want, like some of the high dividends. So how do we pair that together and give a balanced solution that really fits in the middle? And we think this does that. And the asset raise has spoken for itself, I think. Yeah,
no, definitely proves the strategy is something that works and is very appealing. All right, so that was DIVN. So I really appreciate the information on that one. Can we dig into the details of FLXN a little bit? So I know you mentioned this high yield. What kind of holdings does it have? And then what's your options strategy look like on that one?
Yeah, so with this one, right, we're not at this point, we're not a bond selection shop. And so we just use passive high yield exposure. And we're using one ETF right now, but there's a handfuls that we like to use as sort of the core building block of that. That just gives the high yield component. And then on top of that, what we're doing is we're selling a 30-10 put spread on the S&P. And if you think about a sizing perspective, again, the way we thought about this is how can we add about, call it 1.2 to 1.4 high yield exposure, sort of like give that experience to the client. And so, right, you need to come up with some way to get that exposure. You could just add leverage, but you're not going to get there with the income side. And so let's do this by selling put spreads. We're doing 50% notional. And if you think about like the beta of high yield to S&P, what that's giving you, once you sort of think about the risk over time, is it's giving you about that 1.2 to 1.4 experience. And that's what we found is obviously if the market sells off, there's basis risk. S&P, you're going to potentially capture more risk. But if you've looked at the option market, one, there's not a great option market in high yield, even HYG. In addition to that, vols just aren't very nice, meaning they're just not very high. And so you can sell a lot less S&P, and S&P and high yield are pretty fairly correlated, decently correlated. And so you could sell less S&P exposure and still get more for it and give yourself what you're looking for without having to like go into the high yield market and give up all the upside that you may want from high yield. So yeah, it's still a total return experience is kind of what we're going for. But in the meantime, not only are you getting the high yield, but you also get the opportunity for that sort of premium income from the put spreads. And so I think it's, again, what's high yield now? 7 or 8%, 12-month yield, right? And then you add an extra 2 or 3 on that right now. And it gives you that nice sort of trade-off where you're getting sort of a juiced up high yield exposure. Again, this is risky, so I wouldn't just own this, but it pairs nicely in a fixed income portfolio alongside core aggregate bonds or other types of exposures as sort of like a riskier fixed income type exposure.
Yeah, that certainly makes sense. And that being said, a put spread is relatively safe, if you will, option strategy. So you're not really taking on a ton of extra risk, but you are getting that a little bit of premium that you can use to enhance your yield over time. So overall, really good package. And to your point, the S&P and the high yield bonds are very similarly correlated. So it makes sense that you're linking them together in this particular ETF style. All right, and on both of these ETFs, how often do you guys pay the distributions?
Yeah, quarterly. So we've talked about monthly, but what we found for most of our investors is they all have drip programs, and
Mhm.
so it doesn't really matter if you pay it monthly if it's just getting reinvested anyways. 95% is a dividend reinvestment. Not really, because it's just a total return story. And so we've just sort of stuck with something that we think is easier, especially in the context of a model portfolio, which I don't know how much conversation, Jeremy, or time you've spent there. But if you're kicking income out into a model portfolio, then you have to do something with that income. And I mean, theoretically, you just buy the same security, but it can get a little bit operationally complex. And so quarterly seems to work fine for us and our investors. And we've never heard any pushback, but I do know there's a lot of folks that are not just monthly, but weekly payers. And that's, again, it's a different distribution angle. That's just not who we distribute to. And so what we're doing works great for our investor base and what they're looking for.
So we talked a lot about both of these, and it does look like these are part of a larger portfolio, a well-balanced portfolio. These are a piece of the puzzle. But how do you guys see these ETFs playing out in an investor's portfolio, especially someone who's looking for income?
Yeah, I mean, for us, if we think about our goals-based framework, this fits really nicely in the distribution phase, which is typically somebody that's looking for retirement. And so that is typically focused towards income because it helps support that spending. And so the dividend piece we think could be a core holding there. The FLXN, which is the high yield exposure, right? I mean, if somebody's looking for higher risk bond exposure, so let's say you're an accumulation client, you're younger, you don't necessarily want 100% equity, but you want some fixed income, right? That gives you an opportunity to reach for some fixed income that's going to give you a little extra, right? We think that works, but it could fit nicely in an income story for a retirement individual too. And we think that one has a dual purpose, much more so. And I mean, the dividend income, I mean, to be honest, we're also using it in just broad-based allocations like accumulation or anybody that's not even looking for retirement, because it's such a high quality dividend exposure and the yield isn't, yes, it's there, but it's not going to totally blow up the beta. You're still going to get some risk and some participation, total return. And we think that's pretty important for anybody. And so we see it being used as sort of like a value dividend type exposure in other parts of the portfolio.
Yeah, that's exactly how I envision it. All right, so we've been talking about DIVN, which is a Horizon Dividend Income ETF, and FLXN, which is a Horizon Flexible Income ETF. Where's the best place for people to get more information about either of these two products?
Yeah, horizonetfs.com. That has these two ETFs and then all of the rest of ours. And from there, you can peruse to the rest of our sort of solutions. And when you could buy these on all the places you can buy every other ETF these days, which is the beauty of ETFs. So, happy to just Horizon ETFs. That's where you can find everything. So
perfect. Make sure to add the link on the description as well here on the screen. Clark, really appreciate all the information you're able to provide to us on these two products, as well as your company, Horizon Investments. Really appreciate you coming on, and thank you so much, and hopefully we'll be able to talk real soon.
Thanks, Jeremy.
All right, thank you.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.